I'm Lucifer, and today, I'm going to reveal why stock market crashes aren't accidents. They're the moments that separate panic from opportunity. Every time the market collapses, millions of people rush to sell. They believe they're protecting their money. But what if I told you the greatest fortunes in history weren't built during bull markets? They were built during moments of fear. Today, I'll show you what really happens when the stock market crashes, why ordinary investors lose everything, while disciplined investors quietly build wealth. This isn't magic. This isn't luck. It's psychology. Let's begin. Imagine you're sitting inside a crowded movie theater. Everything seems normal. People are laughing, talking, enjoying the show. Then suddenly, someone stands up and screams, "Fire!" Nobody stops to ask if it's true. Nobody waits for evidence. Everyone runs. People push each other. Fear spreads faster than facts. Now replace that theater with Wall Street. Replace the audience with millions of investors. And replace the word, fire, with one terrifying headline: "The stock market is crashing." The result is exactly the same. People panic, they sell. Others see the selling, and they panic too. Fear becomes contagious, and within hours, billions of dollars disappear from the market. But here's the first secret. The companies themselves didn't suddenly disappear. The factories are still producing. Employees are still working. Customers are still buying products. Only one thing changed: people's emotions. And emotions can move markets faster than reality ever can. Now here's the question. Why do stock market crashes happen? Most people believe it's because companies suddenly become worthless. But that's rarely the whole story. The real force behind every major crash is human psychology. When markets rise, people become greedy. They believe prices will keep climbing forever. They buy more. They borrow money. They take bigger risks. And eventually, prices rise far beyond what businesses are actually worth. That's called a bubble. But every bubble has one thing in common. It eventually bursts. The moment fear replaces greed, everything changes. Investors begin selling. Selling pushes prices lower. Lower prices create even more fear. And suddenly, the panic feeds itself. History has shown this pattern again and again. The Great Depression, Black Monday, the dot-com bubble, the global financial crisis, the COVID market crash. Different events, different causes, but the same emotions: greed, fear, hope, regret. Markets may evolve. Technology may change. But human emotions remain exactly the same. That's why history often seems to repeat itself. Now here's something most people never realize. A falling stock price doesn't automatically mean a company is failing. Sometimes, it's simply fear driving prices lower. Imagine your favorite smartphone suddenly goes on sale for half price. Would you refuse to buy it just because it's cheaper? Of course not. Yet in the stock market, millions of people do exactly that. When prices fall, they assume something must be wrong. Sometimes they're right. But many times, fear is louder than reality. And that's exactly where experienced investors begin paying attention. Now let me tell you something. That separates ordinary investors from extraordinary ones. When the market crashes, most people focus on what they're losing, but experienced investors focus on what they're gaining. Opportunity. Imagine walking into your favorite store. Everything is suddenly 50% off. Would you panic? Or would you start shopping? Most people love discounts until those discounts appear in the stock market. That's when fear takes control. Legendary investors understand something different. They know that a lower price can mean a better opportunity. Not always, but often. That doesn't mean buying every stock that falls. Far from it. A smart investor doesn't chase cheap prices. They search for strong businesses, companies with real products, real customers, real profits, and the ability to survive difficult times. Because not every company recovers. Some disappear forever. That's why knowledge matters more than emotion. Patience matters more than prediction. And discipline matters more than excitement. The goal isn't to guess tomorrow's market. The goal is to own businesses you believe can still succeed. 5, 10, or even 20 years from now. The greatest investors never built wealth by reacting to headlines. They built wealth by thinking beyond them. While the crowd asks, "How much could I lose?" the patient investor asks, "What could this business be worth in the future?" That single question has created more wealth than panic ever will. So, what's the biggest mistake investors make during a market crash? It's surprisingly simple. They confuse price with value. Just because a stock price falls doesn't automatically mean the business is broken. And just because a stock price rises doesn't automatically mean it's worth buying. Price is what you pay. Value is what you get. The market doesn't always know the difference, at least not in the short term. During a crash, news headlines become louder. Social media spreads fear faster than facts. Friends tell you to sell. Experts argue on television. And suddenly, it feels like the entire world is falling apart. But remember this. The market has one powerful habit. It overreacts. In good times, it becomes overly optimistic. In bad times, it becomes overly pessimistic. Successful investors understand this cycle. They don't ignore risk. They manage it. They don't buy because everyone else is buying. And they don't sell because everyone else is selling. They stay calm. They follow a plan. Because real wealth isn't built in moments of excitement. It's built through consistency, through patience, through discipline. Every major market crash has tested investors emotionally. Some gave up. Others stayed the course. The difference wasn't intelligence. It was emotional control. The stock market has often been described as a machine that transfers wealth from the impatient to the patient. The next time fear fills the headlines, ask yourself one question. Am I reacting to emotions, or am I making a thoughtful investment decision? That answer could change your financial future forever. So, what's the real lesson? Stock market crashes don't create fear. They reveal it. They reveal who invests with emotion and who invests with discipline. Some people see a collapsing market. Others see the chance of a lifetime. The difference isn't luck. The difference is knowledge. It's patience. It's the ability to stay calm when everyone else is running. Because history has shown us one important truth. Markets rise. Markets fall. But fear never lasts forever. Every generation believes their crisis is different. Yet time and time again, the market has found a way to recover. That doesn't mean every investment succeeds. And it doesn't guarantee what will happen next. It simply reminds us that smart investing is built on research, patience, and long-term thinking, not panic. So the next time you hear the words, "The stock market is crashing," don't ask, "How much can I save by selling?" Instead, ask, "What opportunities might careful investors be studying right now?" Because the biggest opportunities often arrive wearing the mask of fear. I'm Lucifer, and now you know the truth behind stock market crashes. If you enjoyed this episode, subscribe, because next time, I'll reveal another money secret that could change the way you think about wealth forever. Until then, stay curious, stay disciplined, and never let fear make your financial decisions. I'll see you in the next episode.